NIO just wrapped up another week of trading, and while it wasn't the biggest price surge we've seen lately, closing the week up almost 3% at $5.01 a share says a lot, especially considering the broader market volatility. It's moments like these that make you stop and ask, is NIO setting up to be one of the biggest underdog stories in the EV market going into 2025? Over the past few weeks, NIO has begun showing signs of real momentum. Not the hype-driven rallies that disappear overnight, but a consistent and technically supported climb, fueled by rising confidence in its execution and strategy. After breaking past key resistance levels and reclaiming a spot above the $5 mark, the stock has become increasingly difficult to ignore, especially when other EV names are still trying to find their footing. And here's the thing, while most of the market has its eyes glued to Tesla or watching BYD's international expansion, NIO has been quietly building out a compelling story of its own. One that mixes smart infrastructure plays, an evolving product lineup, and something Wall Street often overlooks, resilience. Let's talk about why that matters. NIO is one of the very few EV companies that decided not to follow the crowd when it came to infrastructure. Instead of competing solely on vehicle specs, it leaned into its battery swap stations, and now that decision looks smarter with each passing quarter. Over 3,100 stations are now live, and many of them are already break-even or profitable. That's a game changer. It's not just about selling more vehicles. It's about building a network that brings in recurring revenue, customer loyalty, and long-term cost advantages. While other EV makers are investing billions trying to catch up on charging infrastructure, NIO already has an established footprint. And with growing adoption of battery-as-a-service subscriptions, that investment is beginning to pay off. What we're seeing is a rare thing in the EV space, early infrastructure bets translating into measurable business value. It's one of the reasons sentiment around NIO is beginning to shift, and why bullish investors are starting to believe that this isn't just a speculative growth stock, it's a company evolving into a more balanced, more efficient business. Another area where NIO is starting to separate itself is in its product strategy. The launch of the Onvo brand and the Firefly line aren't just new vehicles, they're symbols of a broader move into the mass market segment. That's critical. For a long time, NIO has operated in the premium EV space, competing with high-end models from Tesla and traditional automakers. But if Onvo and Firefly can capture even a modest slice of the mid-tier segment, it could unlock scale benefits that accelerate the company's path to profitability. That's not just a fantasy either. Recent delivery reports suggest those models are being well received. And with NIO continuing to focus on streamlining production and trimming costs, those volume gains can flow straight into margin improvement. Investors have been asking for that kind of discipline for years, and we're finally starting to see it in the financials. Gross margins are recovering, SG&A costs are trending toward 10% of revenue, and the company has signaled its intention to be profitable by the end of 2025. These aren't promises, they're objectives backed by operational results. At the same time, the technical picture is matching the narrative. The stock's move above $4.90 was a breakout with real volume behind it, and this week's close above $5 confirmed a new trading range. That matters, especially for swing and momentum traders who are watching for signs of sustained recovery. Short interest remains elevated, which could fuel more upside if NIO delivers another strong month or surprises in its next earnings report. And yes, risks remain. It would be unrealistic to paint a one-sided picture here. NIO still operates in a competitive Chinese EV market, regulatory headwinds are always a factor, and global macroeconomic conditions could dampen near-term growth. But what's encouraging is that the company is clearly aware of these risks and appears to be proactively managing them, through cost control, product diversification, and infrastructure expansion. If you take a step back and look at the broader landscape, what's becoming clear is that NIO isn't trying to be Tesla. It's trying to be NIO. And that distinction is important. Because when you build your own lane, whether through battery swap tech, new brand segmentation, or a unique customer experience, you're not just reacting to the competition. You're defining your own success metrics. That may be why, in recent weeks, we've started to see a pickup in bullish sentiment. Retail investors are starting to talk about NIO again. Options activity has increased. And there's chatter in the institutional space about re-rating the stock if delivery growth and margin expansion continue into the second half of the year. Looking ahead, there are some key things to watch. First, we'll want to keep an eye on August delivery numbers. If Onvo and Firefly volumes accelerate and push total deliveries higher, that would signal demand is building exactly where NIO wants it. Second, earnings are on the horizon. Commentary from management around cost structure, swap station utilization, and product segmentation will offer critical clues about the company's trajectory. Third, the infrastructure play may start to get the spotlight it deserves. If we hear more about new partnerships, swap station expansion outside China, or recurring subscription revenue growth, that could spark a revaluation of the business model altogether. The truth is, the EV space is still young. And while giants like Tesla may dominate the headlines, there's room for multiple winners, especially those willing to execute patiently and strategically. NIO may not be the flashiest name in the space right now, but sometimes, the most compelling investments are the ones that quietly build a foundation while everyone else is chasing the next hype cycle. So as we head into the weekend, it's a good moment to reflect. NIO is holding its ground above $5, attracting new investor attention, and delivering on milestones that just a few months ago felt far off. If this trend continues, we may be looking back on July and August as the period when NIO transitioned from risky turnaround to emerging winner. Thanks for watching. If you've been following this story with me over the past few weeks, I'd love to hear your thoughts. Are you feeling more confident in NIO's direction? What are you most excited or cautious about as we move into Q3? Drop your comments below, and don't forget to like and subscribe if this video helped you stay ahead of the curve. Enjoy your weekend, and I'll see you next week with another update.